The United States is about to spend the most amount of money it's ever spent in the history of its existence. So where does the yield actually come from? Well, it comes from the AI sector growing and growing every year. DeFi has an opportunity to put itself at the center of the AI revolution. The United States is about to spend the most amount of money it's ever spent in the history of its existence for the AI infrastructure build-out. It's going to cost about $7 trillion for the next 5 years. It's a lot of money. And to visualize a single data center, such as a single gigawatt, which sounds moderately small, it's also the same amount of energy you would spend for the entire city of Denver. It's also the equivalent of about 30 Las Vegas spheres. It's very, very large. It's incredible amounts of money being spent, and the infrastructure that we have in the capital markets does not keep up with the speed at which AI needs to grow. To illustrate a single build-out of a single gigawatt, just for measurement, it costs about $50 billion to build a single gigawatt data center, of which 20 to 30% is more the shell and power. So what is the rest of the 70 to 80%? That's most of the costs. Well, this is why NVIDIA is the most valuable company in the world. These are the chips. And what separates the shell and the power versus the chips? Well, it's the access to capital markets. When you have the power and shell, these are very long-term assets. The land, the build-out, these are 30-year mortgages. And when you have a mortgage, that implies the existence of a mortgage-backed security. It's very easy to securitize the underlying assets into things that are tradable. So when you give a loan, well, you can get a receipt that makes you borrow against it or get liquidity. And that's what people trade on Bloomberg. The issue with GPUs is that once you borrow against them, if you can, you're kind of stuck in the loan. And there are much shorter periods of a loan. There are maybe 3 years or 4 years. But they are 3 to 4 years of holding periods that you hold the loan for the entire duration, versus something like the land power shell, which you can borrow against almost instantly. So you have this issue where when money goes in, the 7 trillion, and it goes into the big data center, you can easily get liquidity for 20, 30% of the data center, but not for 70 to 80. And there's a reason for this. GPUs are extremely new. They are hard to measure. You don't really know the half-life of these assets. How long will they last? 3, 5, 6, 7, 8 years. What makes it difficult is that when you have ways to batch up and create liquidity is that you have to make things tradable. And the land power shell, it's pretty easily tradable because you can securitize it. You can make it tradable by batching it up. The issue with GPUs is that the life cycle of each GPU is very, very short. You have 1, 2, and 3 across maybe a couple of years, whereas a single mortgage can obviously last very, very, very long. This makes it very easy to batch up because it's very easy to underwrite. The cash flows are clear. You know the underlying asset. Where something so short, well, is difficult to batch up, which makes it not as easily tradable. So how do you solve this issue? This is actually where blockchains are incredibly useful because it can make things perpetual. So for example, again, the short loans, is that when there is a loan that is created, it's immediately added to a longer instrument. Let's call this sUSDai. And when somebody puts in money, a small drip of the $7 trillion that we need for the next 5 years, they're not just left holding the risk for that entire period. What they get is a number of sUSDai. So say $1 will create a number of sUSDai. For this example, it would be 1 sUSDai. So what happens is that their money is no longer stuck. They get this representation, which is a lot of loans put together and that they can use to scale their liquidity and to scale the use cases around it. For people that are in DeFi, it's kind of like when you put ETH in staking. Before you had Lido's wrap staked ETH, when you put money in, it was just making money and you really couldn't do anything with it. It was only with the invention of wrap staked ETH that you had an explosion in DeFi because money could be used much more efficiently. So what happens is that you have all these different loans with different maturities, different periods, and different times that are asynchronous. And this always adds yield, and slowly over time, the APR increases into infinity, which is why you have yield-bearing stables as one of the main inventions in DeFi. It's continuous. It starts at 1.0, and it increases over time to that number, versus something like in TradFi, which would start maybe at a discount because it is synchronous. It would start at like 90 cents and would mature to 1 because there is a vintage and there is an end to that instrument. And this would require all these loans, which is how the land power shell works, is that you would require all the loans to be batched all at once together. And that's why you start at 90 cents and it matures directly to $1. And that works great for things that is easy to batch. But remember, the time it takes to do all that can take up to 3 years, which just doesn't work for the half-life of GPUs. So what happens is that these instruments end at this period versus something that just keeps on going and going and going. So where does the money actually come from? How is the yield actually generated? Well, it comes from the AI sector. There is a large, well-capitalized company, maybe they raised a few billion as a Series C or larger, and they need to have GPUs to service their tokens, to service their end use case, whether it's like a base 10, whether it's Amazon or one of these companies. And they're willing to pay $250 million across the next 3 years. So to provide that service, a neocloud, the actual borrower in this situation, purchases the GPUs on their behalf, which requires $150 million upfront, then and there, to install and provide tokens and services to the end user. So this is kind of where the revenue comes from, is this delta between the $250 million that they're willing to pay across the next 3 years and the $150 million that they need upfront. But it's not that simple. You kind of have to sanitize this entire process in order to get the $100 million of yield across the next 3 years. So the $150 million we divide up between the borrower and the debt. Here we provide 80% LTV of a loan, and the borrower puts up their own 20%. And in this example, for $150 million, $120 million would be provided in debt, and it would be slowly paid over time along with interest in order to maintain a specific ratio. This is a debt service coverage ratio, which is the ratio at which the money that you're generating every month is enough to cover the debt repayments, including interest rates and amortization. So in this period, this is kind of like a nice cash sweep, is that a lot of the dollars that they're earning every single month from their customer is being used to pay down two things. One is a little bit of interest, this is just a single payment here, along with debt amortization, which we'll use a different color. And this helps de-risk the loan over the period because, well, GPUs, they depreciate. It's not land, power, and shell. These things we don't really know the life of. So the best way to de-risk the loan is to make sure that the loan decreases and the LTVs decrease faster than the actual life of the GPU. This is why we have amortization. The loans de-risk over time, and by the time you're at, say, year 2, you're getting close to a 20 to 30% LTV, meaning that you've already paid down most of your loan, and if they default economically, well, you're mostly covered. So what happens is that every single month, you just have continuous repayment, whereas the actual value of the GPU, which can depend on cash flows, which can depend on secondary markets, might have started at, say, like up here, and it has a useful life of, say, 6 years. but you've de-risked, and it gets bigger and bigger over time, this safety margin, this entire area, the loan becomes safer and safer over time. Additionally, we also have something called the debt service reserve assets, which is at least 3 months has to be held in reserve in prepayment, just in case there's some operational risk. Maybe there's a wiring issue, or maybe there's a payment issue. But that's kind of like a little bit of a buffer. So it's not really 70, 80. It's closer to like 62 to 72, where they pay 3 months worth at least of debt service reserve assets. Now, there's more steps to this than just the amortization to de-risk the economics of the loan. There's also operational things because these are very physical. Unlike trying to repo a car, say, in an interesting neighborhood, GPUs are in very air-conditioned, isolated, and programmatic locations called data centers all over the world. That is something called colocation. But on top of that, what USD.AI does in a checkbox is that it provides all these extra layers of protection to make sure that the GPUs are there and they're easy to take out. We have a few steps that we have. One, and most importantly, we have monitoring. We make sure that the chips we get to see a heartbeat of the chips actually operating to make sure that they're generating income. This is also why we do not finance chips until they are installed in the location, and we have that verification because these are just machines. They're not tracked cars. They are actually operating and live during the entire loan. We also have insurance, both in the value in the case that they depreciate much faster than we expected, and secondly, for catastrophic, whether it's tornado or fire or other things. There's also a perfected lien, so we put it in a UCC filings to make sure that the chips are in fact unrecoverable, and that is co-signed by the data centers themselves, so nobody can take them out without our approval. And if they do default, it's really, really simple to remove them from the site or resell them as the ownership is very clear. They are also co-located in data centers, meaning that the NeoCloud is not necessarily the operator of the shell. Typically, they're different companies. You would have, say, a GPU put into an Equinix data center. Their entire operation of data center management is very different from just installing and owning the economics of a GPU. And that's usually a different counterparty. And let me highlight that specifically, where the owner of the chips would be, say, a NeoCloud, or just borrower. But the shell and the land would be a data center operator. And this is a different company. And that makes a tripartite agreement with the lender easier to manage, as there's always checks and balances. And in a lot of the agreements, such as the perfected lien, as well as the monitoring, some deals we have an offtake agreement, meaning that there is an end customer who is willing to pay, and it's a pretty strong agreement. So even if the fluctuations of prices goes up and down on the rental rates of GPUs, there is a structured payment system that's happening over the next 3 years, significantly de-risking the loan itself. And lastly, the NeoCloud borrower can never get a 100% loan. They have to put up some of their own money, and they're the first ones to lose in the event that they don't repay. So there's a large buffer in terms of, one, the agreements down here, in terms of economics. But secondly, you also have a lot of verification that the underlying asset is in fact protected in the worst case scenario. DeFi has an opportunity to put itself at the center of the AI revolution. And right now, it just needs a little bit of sanitization to make sure that the yield is perfected. And that's what USDA protocol is doing. NVIDIA is expected to sell $500 billion of GPUs in the next year, but really, people are going to pay $700 billion because of the cost of interest. This is potentially the second largest business in AI. Wall Street, the debt. And we are in a unique position with the technology innovations that we've seen in DeFi to unlock capital in a way that traditional finance hasn't been able to solve. All it requires is a bit of institutionalization, higher standards, and sanitization to make sure that something as rough as a GPU in a data center can be crafted into an institutional grade yield. You're seeing this in the headlines. Oracle is maxed out on its borrows. You see private credit reaching its limits because they're trying to use a different tool to solve the problem. Fundamentally, making the debt liquid is one of the only things that has scaled trillion-dollar markets, whether it's housing, auto, or equipment. AI is expected to be the most expensive build-out in human history, but it's missing one of the most important things in order to accomplish that build-out, which is liquidity. By creating risk protection, underwriting cash flows, and creating layers of structured instruments around this problem, sUSDai is primed to not only solve this liquidity issue, but also becoming the interest rate of intelligence. The world thinks that the bottlenecks in AI is energy or compute or memory, but really the cost of capital is what determines how fast this sector is going to grow. And this is what the USDA mission is. What is the cost of capital? How do you price it? How do you make it tradable? And how do you make it available to the broader public?